A handshake that didn't happen. A deal was signed in silence. Canada is reshaping its trade relationship with the US in ways no one expected. In March 2025, US President Donald Trump unexpectedly announced a 25% tariff on Canadian steel and aluminum, citing national security concerns. The move was seen as a reaction to comments from Ontario's Premier after the province suspended plans to raise electricity export prices to the US. Once Ontario walked back its decision, the US rescinded the tariff. Canadian Prime Minister Mark Carney responded by declaring that the old relationship is over and accelerated trade talks with the European Union, Japan, South Korea, Australia, and Brazil, signalling a clear move to reduce reliance on the US market. In March 2025, exports to countries outside the United States rose by 24.8%, the second largest monthly increase on record. Exports to the European Union alone jumped 32.0%, the second largest monthly increase on record. Exports to the European Union alone jumped 32.0%, highlighting growing momentum in Canada's trade diversification strategy. The Canadian dollar climbed to its highest level in 7 months, reflecting growing market confidence. For Canadian workers, currency stability and diversified export markets have helped safeguard jobs in key sectors like steel, aluminum, energy, and agriculture. A stronger Canadian dollar has also kept import prices in check, supporting consumer spending. Following the tariff announcement, several industrial U.S. states, including Michigan and Wisconsin, voiced strong opposition. Major corporations like Foxconn expressed concern about the ripple effects on production and supply chains. The U.S. stock market reacted sharply on May 21, 2025. The Dow Jones Industrial Average dropped more than 800 points, about 1.9%, signaling investor anxiety over escalating trade tensions. U.S. pork exports to Canada took a hit, dealing a blow to farmers and agricultural supply chains. The tariffs also pushed up goods prices, squeezing household budgets. Farmers and workers in export-reliant industries faced job and income insecurity, while stock market volatility eroded the value of many Americans' investment portfolios. After a tense start to the year, Canadian Prime Minister Mark Carney met with President Trump at the White House on May 6 to discuss reopening negotiations on the United States-Mexico-Canada Agreement, USMCA. During the meeting, Carney firmly rejected Trump's offhand suggestion that Canada become the 51st U.S. state, stating that Canada is not a commodity for sale. Canada agreed to resume talks only after the U.S. accepted 3 key conditions: recognition of Canadian sovereignty, a commitment against retaliatory measures, and protection for certain sectors in the revised USMCA. The high-level meeting paved the way for a rebalanced USMCA aimed at mutual respect and fairness. The renewed talks helped stabilize markets and protect key Canadian industries: automotive, steel, and agriculture. For Canadian households, the outcome offered hope for economic stability, manageable consumer prices, and reduced fallout from earlier tariff threats. China and Saudi Arabia are joining forces in an ambitious plan to green the desert worth over $4 billion. Could this desert agriculture revolution reshape global food security and water sustainability? On May 13, 2024, China and Saudi Arabia signed over 70 agreements at the China-Saudi Agricultural Development Forum, totaling more than $4 billion in value. The deals focus on 5 key areas: desert agriculture, deep processing of crops, smart farming, water-efficient irrigation, and seed technology research. These initiatives are part of Saudi Arabia's Vision 2030 strategy to diversify its economy and reduce reliance on food imports. For Americans, the ripple effect is twofold. First, the global food market could shift as Saudi Arabia emerges as a self-sufficient agricultural hub in the Middle East. Second, US egg-rich companies may face new competition from Chinese-led innovations tailored to extreme environments. Technology that could eventually reshape farming in aid regions across the American Southwest. China is exporting its breakthrough rice on sand technology to the Middle East, building on prior success in Xinjiang's deserts where annual rainfall is below 50 millimeters. The method includes turning sand into soil using organic benders, precision underground drip irrigation that saves up to 90% water loss, and AI-integrated monitoring systems to control pests, moisture, and fertilizer use in real time. In the US, this method sparks curiosity for its potential in drought-stricken states like Arizona or California. With water becoming an increasingly scarce and politicized resource, these low-water, high-yield systems might present new pathways for sustainable agriculture in the face of climate uncertainty. To support these agricultural ambitions, China is building the fourth phase of the Rabigh desalination project in Saudi Arabia, a high-tech facility valued at $800 million. Once completed, it will deliver 600,000 cubic meters of clean water daily using cutting-edge RO filtration, with costs down to just 2.3 yuan per cubic meter. The plant will provide drinking water for over 2 million households in Mecca and Medina. For Americans, this project shows what large-scale desalination can achieve when energy efficiency meets engineering. As coastal states like California debate desalination's viability, China's model presents a cost-effective solution that might soon become essential not just for agriculture, but for basic urban resilience. Once the world's sixth-largest wheat producer, Saudi Arabia halted domestic farming in 2016 due to depleting groundwater and unsustainable costs. Now backed by Chinese expertise, the kingdom aims to revive cultivation across 3.5 million hectares of dormant but arable land, just 1.6% of its territory. For American audiences, the move is symbolic. It represents how technology and geopolitics intersect to challenge long-standing ecological limits. If desert farming proves viable, it could change the global agricultural map and offer inspiration for how US regions with marginal land might be reimagined in the future. A new global tech power shift is unfolding from chip wars to trade barriers and domestic economic pivots. Could Western policies be accelerating the very outcome they aim to prevent? NVIDIA CEO Jensen Huang has urged the US government to lift export restrictions on advanced AI chips to China. Once holding 95% of China's AI chip market, NVIDIA has seen its share drop to around 50% after years of escalating tech tensions. Domestic rivals like Huawei have quickly closed the gap, fueled by rapid innovation and government support. Huang warned that if US policies don't change, China will produce its own AI chips, making it permanently independent of American tech. You can either sell chips to China or help them make their own, he stated. This shift threatens a market once valued at over $50 billion, crucial to US semiconductor giants. A permanent loss would reduce American tech exports, undercut industry revenue, and cost high-paying engineering jobs. Investors, tech workers, and US universities feeding into chip R&D may all feel the sting of an eroding global footprint. China is fast-tracking its domestic AI chip capabilities. Cheap electricity, vast land for industrial use, and an abundant pool of STEM talent offer competitive advantages over the US. The country's big fund worth over $100 billion is backing chip giants like Huawei with long-term subsidies and strategic investments. Unlike the US, China imposes no restrictions on selling AI chips globally, allowing companies like Huawei to expand into developing markets with lower prices and early dominance. US export controls are pushing international buyers to seek alternatives from China as US firms lose ground abroad. Domestic prices for AI-driven devices and cloud services could rise. Startups relying on affordable chips may face higher costs or delays, slowing innovation. In the long run, American consumers and businesses alike could pay more for less capable tech while China scales up its global influence. G7 nations led by the US plan coordinated tariffs on low-cost Chinese imports like clothing, electronics, and cosmetics. Washington has removed the $800 duty-free threshold, imposing tariffs up to 30% on Chinese goods. While aimed at protecting domestic industries, the move could raise prices, especially hurting lower-income families reliant on affordable electronics and household items.